First of all, let me thank all of you to have come here to listen to the FII view. And I think over the last few years, we have steadily seen a change in terms of how investment behavior has happened in India. In the past, I would get this question mostly 9 out of 10 times. What will the FIIs do? Now I must say that this ratio has come down to about 6 out of 10. But still, the FII view remains a fairly important view for all of us as domestic investors. Especially as distributors, I think we all have a say in knowing what is the international view in India, because over time we have noticed that when large amounts of capital enter a market, it influences the price. And as you know, it is about demand and supply. If suddenly a lot of demand gets generated for a commodity, the price goes up. And it is very important to understand that when foreigners invest, they invest in large sums. As opposed to when we talk about SIPs, it's a more gradual entry into the market, which doesn't move the price much. And that's why I think we all need to be a little more interested in saying, what is the FII view? And that is a very interesting concept, because at some point of time, we have to understand where the money is made globally. So what I have here is a very brief presentation which takes you through a few things, including the overview of what happened in the last year, which is on the year to date. A little bit of a macro overview about how the world looks like. Where do emerging markets appear in that screen? And find out where in the world policy divergence is at play. We'll also look at implied odds and say where the risks are today. And I think that will probably give an idea about what foreigners are thinking about investing in the world, and where does India then figure out. This chart actually tells you a little bit about the performance of various asset classes in the year 2018 to date. So as you can see, compared to the 2017 numbers, the red bars on that chart indicate 2017 investment returns. And 2018 investment return to date are the black bars. Now, as you can see how cyclical returns are. On a certain year, almost every asset class made money. And you can see emerging market debt, emerging market equities, US equities, global equities, and emerging market equities. The biggest bar in terms of percentage returns, almost 35, 36% for the entire year came from emerging market equities last year. So the 2017 period was extremely beneficial for international investors who invested in emerging markets. Even if you take other asset classes, including oil, gold, hedge funds, listed private equity, or the US dollar, which was the only negative asset class, you can see across the board, especially if people were in your position to say, where should I allocate assets? You could have just blindly put money anywhere and made money. So there was no significant reason to be more active about asset allocation last year, because practically every asset class did well. But this year, apart from US equities and US dollar, everything is negative return, which means all the returns which were made in the last year are significantly lower this year. And I think this is a time for people to pause and say, well, how does the world look like in the next year? Because I am at risk of losing everything I've made in 2017. Half of it I've already lost this year. And what does 2019 look like? So I think this is a question where a lot of international asset allocators are really, really bothered, and they're looking for positive return. They really are looking for an asset class which will give them positive return. These are the causes of what happened in 2018, and I don't want to repeat them too much, but as you can see, the beginning of the problem started from the fact that the US increased the rhetoric on the trade war. And as a result, everybody was worried that trade is going to come down and corporate profits as a result will get hit. Especially emerging markets, which are very vulnerable to trade flows, will get hit the most. So as you can see, the three squiggly lines across, the dark black bar represents developed market equities. So developed market equities over the year are flat. They didn't really make much money. If you look at emerging market equities, which is the very gray line, which has steadily fallen in the entire year. So if I go back to say, what did emerging market equities do? They did the worst. As opposed to when they did the best in 2017, in 2018, they did the worst. So here you can see the reason why emerging markets took such a big hit is because of the dollar rally, the China macro disappointing, and then eventually there were some very country-specific risks like Turkey and Argentina, which caused the sentiment to be broken in emerging markets. So emerging markets really were not a very happy space for most people to be in last year. And I think that becomes very important for us to look at this now to say, well, where do foreign investors look for return this year? Emerging markets last year actually had something what we like to call it as a doom loop. You know, it's like a doom loop. One news leads to the other, and it only crashes the entire sentiment. So it started with the shift in sentiment due to the trade concerns, the trade war. It began like that. So when I talk about this loop starts from here. Shift in sentiment due to trade tensions. It leads to US dollar shock. What happens is when trade becomes weak, the stronger trading partner always wins, right? And this situation, the US dollar became very strong. It was not estimated, and that's why we call it a dollar shock. Whenever there's a dollar shock, all the emerging market currencies versus the dollar start to weaken. So that was a second aspect of the doom loop. Then it led to emerging market growth momentum hit because of inflation concerns. And that is how that loop starts. Then idiosyncratic risks, say for example, I mentioned Turkey. There was a political situation there, and the Reserve Bank in Turkey and the government, just like guess which other country, they had a little bit of a disagreement where the president of that country was really upset with what the Reserve Bank of Turkey was doing. And that leads to a very idiosyncratic, or what we call a specific emerging market problem. Argentina also faced a similar problem. Then there is a further sell-off. So as you can see, the sentiment leads to the situation being much bleaker than it is, and then it leads to sell-offs. Now the sell-off, because of those sell-offs, the other emerging markets are affected, and then investors start thinking, okay, now what next? So as you can see, last year was not really a very happy year for emerging markets, which began with trade war issues. But as you can see, all emerging markets did not do similarly. So as you can see, some emerging markets did much worse. So for example, if you take Argentina, equity returns in Argentina were down 70%. Aren't we happy that we are not in Argentina, right? So this was the worst affected of all emerging markets. If you see the least and the positive returns across emerging markets were only in Russia. And guess why? Price of oil. So obviously, Russia makes a lot of money if oil goes up. They have a tremendous reserve of oil. That was the only country which was led by a commodity price where equity returns were positive. But all across emerging markets, returns were pretty negative, ranging from the very low that Argentina had to an average downturn of between 10 to 15% across. And India, of course, there, not really that worse off because we are talking about the Sensex. It did not really do that badly. In fact, as we see today, on a YTD basis, the Sensex is positive. So here, this doom loop, as we call it, hit most emerging markets. But what is it that drives stock prices? Earnings. So if you look at this left chart, it talks about global equities. So this is the whole world in equities together, where world equity prices are going and where earnings are growing. Now there seems to be a little bit of a divergence between where earnings are going, which is the black line, and where stock prices are going, which is the red line. So while we can argue that stock prices have fallen, the argument is not based on earnings growth. It is something else. And I think earnings growth, yet in spite of all of this, continues to be pretty strong across the world. If you look at the decomposition of earnings return, so for example, when we say the stock price goes up, part of that stock price going up is a PE increase, that is if the multiple increases, or if the earnings growth comes in. So if the earnings growth is 10% and the stock price goes to 10%, most of the earnings growth that you get is in the price. But if earnings growth is 10% and stock price goes up by 20%, what is that extra 10% giving you? It is called as a multiple expansion. So total stock market returns can be decomposed into earnings multiple and earnings growth, and you add dividend yield to that. And when you can, then that's your total return from equities. If you decompose that between US equities, world equities, and emerging market equities, the return decomposition was that earnings growth was positive across all the three. So this black bar is positive. But the total return that you saw actually came from a derating, which means that while earnings growth was X and the PE multiple was Y, the total return is X plus Y. But if the multiple has been derated, then even if earnings growth is positive, your return is less than the earnings growth. And that's actually what has happened in USA, in the world, and in emerging markets. But as you can see, the derating is the maximum in emerging markets. Of course, the earnings growth also is not that high, but the derating is significant and something to do with what I talked about earlier about the trade tensions and what people are worried about. So while earnings determine where prices go in the long run, in the short run, even if earnings are going up, stock markets can come down and they can derate the PE. And this is really where we think that going forward, earnings growth can be very, very significant. I talked about policy divergence. What this means is that all emerging markets don't have the same problems. So here we see that while interest rates were increased in certain countries, where India also was part of that, in certain countries interest rates were decreased. So which means emerging markets are not really homogeneous in that way. And that we don't have to look at them to say, oh, is emerging markets positive this year or not? Because now they represent a little bit of a shift, and you have to be selective about what emerging markets to go for. And as you can see, even the currency has shifted in the favor of the fact that they have corrected too much to think that emerging markets currencies can actually come back again. So two things now foreigners are thinking. Earnings growth is coming back, and second is the dollar is going to be weaker against the emerging market currencies. When these two things happen, emerging markets become attractive. Also what happens is when last year you had such a negative cycle in earnings growth as well as derating, typically what happens? The cycle starts to work against you. And over a period of time, emerging markets, as a result of which, start to look good. There are other concerns. So for example, if I was an allocator in the US and say, okay, where will I get positive returns? Is UK equities a good place to go? Probably all of you agree that because of this Brexit problem, UK is not a place to put equity money right now. Their currency is weakening, their trade situation is worsening, there is a lot of uncertainty, and asset prices are coming down in the UK. So I don't think I'll allocate to the UK. If I want to look at some other parts of the world, Eurozone is not a place that I want to put my money in also, because there are concerns about growth in that area. So I am taking money off the table. The US has had a fantastic year last year. Earnings are unlikely to sustain. Eurozone is not really attractive. UK clearly not. What do I put money in? And I think this is where a lot of people make a mistake, that they feel that the cycle is over. Our theory is that in the past, cycles used to be very short. But I think over a period of time, cycles may actually be a lot longer than we think. And when we say US has had 36 quarters of high earnings growth as well as GDP growth, there have been other times in different countries where the boom has lasted a lot longer. So I think one is very clear on the fact that equities as an asset class remains a very strong asset class to remain in across the world, but more so now because of the kind of returns which have already been received in the US and Euro and the UK. I think the shift in terms of attention is likely to go towards emerging markets. And this is basically how we as a foreigner, as HSBC Asset Management looks at the world. And if I look at the asset classes available, they go from sovereign investment grade bonds to hedge funds, to emerging market securities, to emerging market debt, to private equity, the whole gamut of what an asset allocator is likely to put money in. And the attractiveness of which asset class looks the most attractive is if it is above the gray line. If it is above the gray line, the expected volatility for the kind of risk that I can take is much higher, which means that the risk reward is in my favor. Anything below the gray line is not that attractive. And it's very easy to understand. So the worst on this chart, what I will not put money in is UK gilts and German bonds. So these are sovereign bonds of Germany and the UK. What does that tell you? If interest rates are going to rise in that country, bond returns become negative. So that's a very clear indication. So this is the worst asset class that someone can put money in for next year. If I start looking up, US equity is right there in between, so which means risk reward is balanced. But if you look at emerging market equities, which is right up there, so high volatility and high returns, emerging market, Asia ex-Japan equities, they're right up there. They're not above the gray line yet, but they're in still very attractive zone. What is above the gray line? Japanese equity, Euro equity, local emerging market debt. So as you have seen, in the year 2017, we attracted a lot of foreign capital in our domestic debt, which also led to a pretty significant increase in the rupee. I think emerging market debt in local currency is very, very attractive this year. Because of the currency fall as well as the very high yield which is available, I think that might be another reason. So which means two things are in our favor. India rupee is likely to appreciate. India earnings are very strong. And from a global perspective, they are in a very attractive space as an emerging market country, versus all of the other options available for foreign investors today. And the allocation can differ depending on their risk potential, but the fact remains that India is in a fantastic space this year to attract foreign capital, which was not the case last year. So I think these things really make us very confident of the fact that foreign interest in India equities can be high. Foreign interest in India debt can also be very high. And that's the worldview as we look at. A little bit about credit risk. Many times people look at investing in credit. Right now, the attractiveness for buying credit in an emerging market has just become slightly more attractive than buying credit in developed markets. That's the slight change. It's not a very dramatic change, but it's there. So what are the risks? I mean, so far I talked about the potential return, but the risks clearly are going from low impact and positive surprise to negative surprise. The biggest, so for example, if you have to say high impact and the biggest negative surprise, if I say the worst case scenario is an inflation shock to the world. If inflation really goes up very dramatically, then all asset classes will suffer. But that's probably a little bit of a low probability event. That's the worst case. If I look at high impact and positive surprise, what is when most of the positives will come through in investing and emerging market rebound? All of the emerging markets, if they have a GDP growth rate, a rebound, you're going to see the entire world go up in asset prices. And there are some other things which we don't have the time to discuss, but the fact is that the risk and reward for foreign investors investing into emerging markets generally and in India specifically is a very, very strong time at this time, considering what has happened in 2017 and what has happened to 2018 so far. So that's the FII view in India. I really hope that that translates into some sort of positivity for you to give your investors assurance that yes, the India domestic story is fine, but I think even the foreigners find it attractive. I again would like to thank all of you, especially the organizers, to invite me here. Thank you. Thank you very much.